On a quiet Thursday in August 1971, just 48 hours before the United States would sever the last formal tie between the dollar and gold, something happened inside the vaults that almost no one noticed. A massive movement of gold was processed by the Fed's New York office. Large sums moved. Central banks that had been quietly accumulating for months began to act. France, among others, accelerated its repatriation of gold. The public did not know. Congress did not know. But a very small circle of foreign central bankers and Wall Street dealers understood perfectly what those movements meant. A structural crisis was imminent. The transfers weren't a leak. They were a signal, one of the quiet signals central banks have used for more than a century to communicate that the monetary order is about to change. Ask yourself this: what happens when the people who hold the world's money start acting before anyone else even hears the warning? You don't get a calm transition. You get a shift, a redistribution, a new map of power. Because money is not only a unit of account, it is the mechanism by which nations wield leverage. And leverage is what the dollar was built to deliver. You grew up learning that the dollar was the world's anchor. It paid for oil. It paid for grain. International contracts were dollar-denominated. Reserves were dollar-heavy. Banks ran on dollar liquidity. That arrangement felt permanent because it had lasted for decades. It started in 1944 at Bretton Woods. After a world war, the Allied powers designed a system where the dollar would be the center. Other currencies would peg to it, and the dollar itself had a gold tether. That tether gave the dollar the credibility of metal, and credibility became power. Power buys privilege. The United States discovered what economists call an exorbitant privilege. Because the rest of the world demanded dollars, the U.S. could run trade deficits, borrow in its own currency, and import real goods for paper promises. Privilege made daily life easier in powerful and invisible ways. Schools were built, roads were paved, wars were funded, but all privileges also create perverse incentives. To supply the world with dollars, the United States had to run deficits. And once deficits accumulate, trust erodes. This contradiction, the Triffin dilemma, doesn't exist in textbooks alone. It shows up as shortages, as frantic gold withdrawals, as the kind of hush-hush transfers that happen in vaults at night. And when the people who manage money lose faith, the consequences ripple out much faster than any politician can react. By the late 1960s, the system creaked. Nations were increasingly presenting the U.S. with claims on gold. The U.S. had less of it. A few nervous calls, a few large transfers, then a decision at the top: cut the tether. On August 15, 1971, Nixon closed the gold window, the symbolic and practical anchor of the post-war monetary system, and the dollar became a pure fiat currency overnight. The official history is clear. The Nixon shock rewired global finance. But the story of that weekend begins earlier, inside the vaults and meeting rooms where gold and leverage intersected. When a currency loses its metal backing, its ability to command global loyalty depends on much more than numbers on a balance sheet. It depends on political credibility, on military power, on trusted markets, and on a perception that the issuer will not weaponize the currency against others, that it will be neutral enough to be useful. That perception lasted a very long time. But perceptions can shift overnight if key players decide they no longer trust the system. There is a pattern, not a conspiracy, but a pattern of behavior that repeats when the existing monetary order is about to change. I call them the 3 silent signals. They are not obscure macroeconomic charts you must decode. They are simple, observable actions central bankers and treasuries take. Actions so basic you can watch them with your own eyes if you know where to look. Signal 1, large-scale reserve reallocation. Central banks quietly move holdings away from assets that can be weaponized or frozen. In the 1970s, it was gold withdrawals and repatriation. In the 2010s and 2020s, it's strategic shifting of holdings and new custody arrangements. When you see coordinated reallocation across multiple middle powers, you should take notice. Signal 2, operational plumbing changes. Nations expand bilateral currency swap lines. They build alternate clearing systems. They test or roll out digital currency rails. These are not headlines. They are infrastructure. Infrastructure determines who gets paid when politics gets ugly. Signal 3, real asset accumulation. Large, deliberate purchases of neutral stores of value, gold, strategic commodities, ownership stakes in critical supply chains, indicate that the world is preparing for a future in which fiat paper may be instrumentalized. When these signals flash together, a reset is in play. They were present before the end of the gold convertibility era, before the 2008 crisis, and before the global shock of 2020. And they are visible again now. If you want to know whether the monetary system is at risk, watch for these three moves, and watch to see whether they are coordinated or isolated. In February 2022, Russia invaded Ukraine. Western governments didn't just sanction individuals, they took an extraordinary step. They froze tens of billions of foreign reserves held on foreign soil. By mid-2023, the estimate of frozen Russian central bank assets ranged roughly between $300 billion and $335 billion, a staggering portion of a major central bank's holdings. That action changed the frame. Countries started asking themselves a fundamental and uncomfortable question. What if our reserves can be immobilized for political reasons? If a reserve asset can be disabled as a tool of geopolitical pressure, it loses a core benefit: reliability. A trustworthy reserve must be accessible. That simple insight sent policymakers racing to diversify custody, to rethink currency exposure, and to accelerate plans that had been simmering for years. The 2022 freeze didn't create the incentives to diversify. Those incentives existed already. But it created an urgency that made deferred decisions immediate. Ask this: if you were a finance minister and you believed your country's access to offshore reserves could be cut off in a crisis, what would you do? You would move to assets that cannot be frozen, you would test alternate clearing systems, and you would strengthen domestic tools for currency settlement. That is exactly what we have seen. The World Gold Council reports that central banks purchased record amounts of gold in recent years, more than 1,000 tons in 2024 alone, and central bank buying has exceeded 1,000 tons for multiple years running. The pattern is broad-based. Poland, Turkey, India, China, and several others pushed purchases. Some emerging markets were particularly aggressive. Institutional demand for neutral assets is surging, not because of nostalgia, but because gold is portable, liquid in any regime, and unfreezable by foreign policy. China, for example, has been steadily increasing its holdings. Official tallies reported early 2025 figures at around 2,285 tons. That is not a symbolic hoard. It is an operational reserve large enough to matter in the psychology of global markets. This is not just about commodities. Central banks are also negotiating swap lines that bypass traditional Western-led systems, redesigning custody arrangements for reserves, and experimenting with digital settlements that could route around vulnerable choke points. The moves are modular. Each one by itself might be contained. All of them together begin to form an alternate financial ecosystem. When the ecosystem grows dense enough, the dependence on any single currency declines. Analysts mapping historical transitions identify a recurring 7-phase arc in which a reserve currency rises, dominates, overreaches, and eventually yields its primacy. The phases are familiar: ascent, privilege, warning signs, diversification, a trigger event, steep decline, and reset. The US dollar has followed that arc before in fits and starts. It ascended in the mid-20th century, gained privilege, faced warnings and crises, and now appears to be in the diversification and trigger phase. What makes this different and more dangerous is the speed of communications, the interconnectedness of global finance, and the geopolitical consequences of weaponizing reserve assets. In prior centuries, transitions took generations. Today, a concentrated political decision in one region can ripple instantly through the web of cross-border claims, swap lines, and financial plumbing. If you believe in the 7-phase model, then recognizing the trigger is the key. The data suggest we passed the trigger in 2022. The next stages, rapid decline and reset, are not inevitable, but they are far more plausible today than they were 5 years ago. Macro shifts are cold numbers on some economist's spreadsheet, until they hit the grocery aisle. Currency re-ranking plays out in everyday life in 3 brutal ways. 1. Imported inflation. As the dollar loses international purchasing power, essential imports cost more. Food, fuel, and consumer goods rise faster than domestic wages. Rising interest costs. Lenders demand higher yields to hold dollar assets if those assets are seen as risky. Mortgages, auto loans, and credit spreads widen. 3. Erosion of savings. Cash and nominal bonds lose real value in a declining currency environment. You don't need economic models to see this. You see it in the bill you pay, the price on the shelf, the shrinking real value of your paycheck. The Fed's actions protect system liquidity and banking stability in the short term. But those same interventions can presage currency stress if they coincide with the silent signals we discussed. Every major reset in living memory, the end of gold convertibility, the 2008 liquidity crisis, the 2020 pandemic shock, included a phase where the Fed or central banks took emergency steps that later were recognized as part of a broader shift. Recognize the pattern, and you have options. Ignore it, and you are simply a participant in someone else's reallocation. Over the past 5 decades, the Fed's crisis playbook contains tactical repeats. We can distill them into a practical, observable sequence. Move A. Rapid liquidity injection. The Fed floods markets with dollars and credit windows open. This soothes immediate funding pressures. It's effective and necessary, but it increases domestic money supply. Move B. Balance sheet maneuvers. The Fed expands and reshapes its balance sheet using repo operations, quantitative easing, or emergency asset backstops. These operations change the composition of reserve assets and can create new dependencies. Move C. Operational leverage. The Fed and U.S. Treasury coordinate on sanctions, custody restrictions, or regulatory moves that can make dollar-denominated assets conditionally accessible. When all 3 moves appear in sequence, that's the red zone. They are not always malicious. Often they are defensive. But when foreign actors see these moves alongside frozen reserves or aggressive sanctions, they interpret them as signs the dollar can be used as an instrument of policy, and they act to reduce that risk. That's the core paradox. The dollar's strength as a lever has become a weakness as other nations hedge against being on the receiving end of that leverage. When people talk about what replaces the dollar, they imagine a single replacement, a new global currency taking America's place. Reality is messier. The likely outcome is multipolar, a web of alternatives that reduce the absolute dominance of one greenback. Take 3 near-term vectors. 1. Regionalization. Blocks settle trade regionally in local currencies and strengthen intra-regional clearing. Digital rails, sovereign digital currencies, and bilateral rails emerge to bypass vulnerable channels. 3. Asset-backed strategies. Reserves that include higher shares of gold, commodities, and strategic equity. Each reduces the dollar's exclusivity. The transition is not binary. It is incremental and strategic. Yet incremental moves can reach a tipping point once network effects, liquidity, usability, trust begin to favor the alternatives. For many nations, moving incrementally is rational insurance. The dollar's dominance allowed the U.S. to run large deficits financed by the global appetite for dollar assets. That funding model enabled decades of an unusual policy mix. Borrow in your own currency while the world supplies real goods. If that model weakens, the U.S. faces 3 intertwined stresses: higher financing costs, reduced geopolitical leverage, and the need to rebuild domestic fiscal credibility under new constraints. Those are not abstract national-level problems. They link directly to interest rates, social programs, and employment. At the same time, nations that once accepted dollars as neutral are reconsidering. Sovereignty concerns and the practical risk of frozen reserves motivate actions that, cumulatively, can erode the dollar's centrality. The risk is not simply inflation or exchange rates, it is the reconfiguration of political influence. This is not a call to panic. It is a call to act intelligently. If you accept the premise that the 3 silent signals are flashing and that a meaningful reconfiguration of reserve strategies is underway, then sensible steps follow. Diversify. Consider a mix of assets that includes real assets, foreign exposure, and hedges with long-term value. Hold liquidity in multiple forms. Domestic cash is necessary, but international liquidity and access to alternative currencies reduce single-point exposure. Understand duration risk. Long-duration nominal bonds suffer when inflation or currency shocks arrive. Shorter duration and real yield instruments can help preserve capital. Consider neutral stores. Historically, gold and other real assets have preserved value across regimes. They are not a perfect hedge, but central banks treat them as insurance for a reason. These are tactical ideas, not ironclad prescriptions. Your planning must match your goals and your tolerance for political and market risk. But ignorance, holding only dollar paper claims while global reserve strategy shifts, is the riskiest position of all. Speed matters. Historically, reserve transitions could take decades. But 2 forces compress time now: instant communication and the weaponization of financial plumbing. One seizure of reserves, one major diplomacy breakdown, one new clearing network gaining critical mass. Any of these can accelerate the pace. The 2022 freeze provided a live demonstration that assets can be rendered inaccessible by policy. Once that fact is widely accepted, behaviors change quickly. Still, a complete collapse of the dollar within months is improbable. A prolonged, multi-year erosion, punctuated by episodes of volatility and repricing, is more likely. That means the opportunity to act exists, but the sooner you take considered steps, the less likely you are to suffer non-linear losses. This is not simply about money. It is about power and foresight. Those who control a reliable medium of exchange control the first layer of global leverage. Those who perceive that medium as weaponizable will build alternatives. That struggle is structural. It is about how the international order is organized. Every generation has watched the shape of global power shift. In the 20th century, it was the British pound to the dollar. In the 21st century, the story is more complex, and it is unfolding in real time. The three silent signals are a way to read that unfolding. They are not infallible. They are, however, testable. When foreign central banks reorder reserves, when new rails are tested, and when real asset accumulation accelerates together, you are watching the architecture of money change. On a quiet August day in 1971, the vaults whispered. That whisper became a historic broadcast, the end of an era and the beginning of a new dynamic. Today, the whispers are louder and more frequent. Central banks are acting, swap lines are being built. Gold piles up again. If you want to avoid being a bystander as the world's financial topology changes, do not wait for the tabloids to realize the story. Watch the three signals. Monitor custody changes. Observe central banks' balance sheets. And make sure your own financial plan accounts for a world where the dollar remains dominant. Perhaps, but less dominant than it once was. We will analyze each of the three signals in detail in the next episode. The specific data to watch, the exact instruments central banks are using, and the practical portfolio steps people of different risk profiles can take immediately. Because history does not hand out fair warnings. It hands out patterns, and those who recognize them early get to decide how to act.